Mastering options implied volatility. By the end of this video, you are going to have a really strong foundational understanding of this thing that drives all option trading, implied volatility. It's part of every single trade, no matter what. So the goal of the video today is to walk you through and set a solid foundation, give you a lot of different examples of key concepts. So different types of volatility, implied, realized, future realized, historic, all of those will be covered. We're going to talk about types of volatility within an individual option. So when we're looking at term vol, ticker vol, strike vol, all of that stuff, we're going to talk about stuff like skew. We're going to talk about the volatility surface. We're going to talk about volatility smiles. We're going to talk about expected moves. We are going to talk about a lot of stuff. And at the end of the video, I'm going to walk you through 9 really common mistakes that options traders continually make with respect to implied volatility. And I'm also going to show you how you can build some of your own little calculators to explore volatility and become more familiar with it. So let's get right in. Quick recap. What is implied volatility? It is simply the future expectation of volatility. We report it or quote it as annualized expected 1 standard deviation range. So you can calculate this for different standard deviations, which we'll talk about. Now, a key component of implied volatility specifically is that this is derived from the price of an option. So if we go to an options chain, here we have SPY pulled up, and I look at this specific expiration, the 15 AUG, just picking something. Now, we can look at any one of these premiums and we can deconstruct it because we already know one important factor, that every single option, the premium is built of 2 components, intrinsic and extrinsic value. Intrinsic is simply how far in the money it is. And then extrinsic is built of 2 components. We have the duration, so the actual days to the contract, and then a implied volatility input. So if we think about all of these different components from the Black-Scholes-Merton model in terms of an option price, there's only one that is unknown, which is volatility. So that means because it's a differential equation, we could just deconstruct everything. We could pull out how much value is assigned based on the number of days, but then we can also isolate what the volatility input is for those. Now, for retail options traders, implied volatility is plenty good. You're not going to get a lot of value of trying to forecast your own volatility other than it being a great exercise. Forecast volatility is when we use different kinds of models. Garsh is a really common one. EJ Garsh with jump to fusion, stuff to take into account gaps. There's all different ways to calculate and try and forecast volatility. But again, most of the time, IV is plenty fine for most traders. The thing to note is that it is different than forecast vol. Forecast vol is when you actually are trying to figure out what the volatility input is versus just deriving it from option pricing, which we do for IV. There's a couple key traits of IV that we have to touch on quickly. Mean reversion and term sensitive. Term sensitive simply means that across these different expirations, implied volatility behaves differently, which I'll give you an example of in a little bit. The other component is mean reversion, which is less understood by most people, I think. So if we take a look at SPX and we zoom this out over maximum time frame, we'll go a little lighter just because it's not going to be able to lift it that much. 5 years is good. And you'll notice that price moves around, it oscillates, it gets overextended to the upside, downside, and it kind of moves around the center of this standard deviation channel. However, you'll notice that the standard deviation channel itself is positive sloping. It has drift. So we're starting at 34.45 for this example, and then the midpoint here is 56.80. So that's very, very clear, positive drift. Now, comparatively, if we look at VIX, VIX is a great visualization because it is the implied volatility for SPX. So we literally can chart what this looks like by itself in a way that's familiar to people. What do you notice that's real different about this? Well, the first thing I notice is that it has these really giant peaks but then they get smashed down. I also noticed that if I were to plot the total drift over this time frame, so it's 23.5 here down to 16, that is a tiny relative move as a percentage compared to what you just saw in SPX. So what is mean reversion in a nutshell? Mean reversion is a magnetic pull that move things towards whatever the baseline is. And for something like VIX, for those that are wondering, it's somewhere 15 to 17, depending on the time frame that you're looking at. 16 is very common. That'll be about what the average is. So mean reverting is an important concept with respect to volatility because it's a highly, highly tradable effect. Cool. Let's take a look at a couple other types of vol, realized vol. This one's super easy. It's literally just what happened. Implied volatility is the forward expectation. Realized volatility is what occurred. Now, realized volatility has some different flavors. In the context I'm using right now, I'm using it synonymously with historical volatility. Historical volatility also means what happened. Now, realized volatility can have some nuanced components, something called future realized volatility, which is not in the scope of this video, but just know that when we use realized volatility, there are some other framings that go with it, but it's very colloquially used as a synonym for historical volatility. Now, you'll notice that for both of these, we're essentially taking some sort of standard deviation range of a move. Now, again, both of these can be set to different periods. However, for realized vol, you have to take the log returns. And this essentially normalizes upside moves, downside moves, so that you can come up with a range. Because both of these, they're giving you a range, not a direction. So when we're looking at the implied volatility for, let's just grab a stock Meta, the implied volatility is 37%. That doesn't mean it's going to go up or down this amount. It just means that that is the one standard deviation expected range for the underlying itself, which that's an important note that I emphasize there for the underlying itself. We'll talk about that in a moment. Here is a simple plot of implied and realized volatility, as well as variance risk premiums, which is another core concept of implied volatility. I have a video on that. Here, realized volatility are the white for two different durations, a shorter term duration, which is more schizophrenic than the longer term duration. This is 30-day. And then the same thing, shorter term and then 30-day for implied. So you can see a common relationship between these expressed through this dotted line. The dotted line takes the difference between these two so that I can see if implied is trending over realized. And you can see most of the time this line is purple, which is representing that being the case, but every once in a while it turns red. When it turns red, you can kind of see exactly what's going on. Realized is spiking over implied. That's less common. So a really core component of options and options trading is that very frequently implied volatility is overstated relative to realized volatility. But you'll notice here that it is not always, and you have to pay attention to that. There's one other thing I want to show you here. You notice how when it does have periods where it starts, realized volatility starts to exceed implied, you notice how it kind of like persists for a little bit? This is called clustering. Volatility has clustering tendencies. So what this means is, again, when we're looking at implied volatility, it tends to hang around where it is until it goes through what we call a transitory phase, which it has some sort of big move. Then it'll cluster a little bit, and then it'll transition back in that mean reverting sense. So those are two really important traits of volatility: mean reversion, clustering, transitory phases, movement between. And let's now take a look at the types of implied volatility. So we already talked about spot volatility. So if we take a look at SPY, the spot volatility is 17.1%. What does this mean? This is 30-day volatility. Now you can see that there's not a 30-day to expiration out there right now, so it's taking an interpolated 30-day vol. That's the point of spot implied volatility. Now, notice how I'm emphasizing this idea of spot so much. Why? Well, it's because there's also a bunch of individual term volatilities. So you notice how implied volatility for spot is 17, but notice how for the 7 July term, it's 10.64, 7 points less. So not only can there be really large deviations between spot and term vol, but term vol can actually tell you a lot. This is where we can see if things have earnings coming up, because you'll look at the term and then all of a sudden you'll see one that has really high vol compared to everything else. Or sometimes there's not earnings there, and that means that the market knows something is happening around then. Maybe there's some sort of big news related to the stock expected to come out. That is really, really telling. Then there is strike IV. So we have implied volatility for spot. We have implied volatility for all the different expirations. And then we have implied volatility for every single option within an expiration. And the relationships between all of these can tell us a lot. Let's talk about this idea of expected move. We already talked about the concept of a distribution curve, specifically one standard deviation moves. So this is just giving you a visual so you can have a sense of what this means. So if we say the one standard deviation move is whatever, it means that 68.2% of the time we're expecting price to remain within that range. But notice there's not a trivial amount outside of that range. You have to keep that in the back of your mind. Now, we can calculate the expected move for an underlying based on its IV. Now, you can use either the spot implied volatility or the term specific volatility, which is a little more accurate. And you can say, what is the expected range? What is the total amount I expect this thing to move over a set duration? So all we do is we take spot times the implied vol times the square root of whatever the days to expiration, the duration that you want to analyze, divided by 365. And you'll notice that these are calendar days. You can tinker with calendar days versus trading days. There's definitely a difference. But one important note is when we're talking about IV, we often are referring to it in calendar days because it's forward, and forward includes weekends. When we're talking about realized or historic volatility, we're talking about trading days, and it's because the stock doesn't move over the weekend. So with this, we can literally calculate a ton of different views of what the expected moves might be. So here's an example where we have a spot price of 159. The ticker vol, which you know what that is now, is 62.51. The term vol is 96.35. Days expiration is 4. So I can take this using this formula and I can figure out what the expected move is for the ticker. $6.58 or 6.54% up or down. Again, it doesn't tell me which way, just up or down. But then you notice how I can do this for all different kinds of views. I can see what the daily move is. I can see what the monthly, annual move is. And all of this is done just by changing the terms input here. I actually have a workshop and a video scheduled for the Outlier Pro members where we're going to build this exact thing together. So to get some experience, and if you're not in there, that's cool. You can just take a screenshot of this, throw it into ChatGPT, and have it walk you through building your own. Now, another couple things to keep in mind. We can take a look at the spot vol, give us an idea of how much this thing might move based on this vol over different durations. We can take a look at the term vol for the expiration. We can take a look at the event vol, which is isolating an individual day in this period, which is, again, really, really cool. Side note, I realized that the term vol was messed up in the copy and paste. This is the correct version to use. Okay, so let's continue. Next, I want to talk about IV rank and IV percentile. When we're talking about volatility, it's not all that dissimilar from fundamentally analyzing a company, where you don't want to compare the sales and revenue of a tech stock compared to a utility stock. They're relative to the individual sectors and industries. It's kind of similar with implied volatility. The implied volatility for something like Meta will be very different than the implied volatility for something like SPY. Now, within those, we can figure out how volatile something is relative to itself to give us a scale of, for example, in SPY, is this 17% implied volatility, is that high or low for SPY? For Meta, is the 37% high or low? And that's what we use implied volatility percentile and rank for. Now, the formulas for both are input here. You can read those on your own. Implied volatility percentile is way better. The reason why it's so much better is because it is very resistant to skew. With something like IV rank, you're anchoring off of 52-week, 1 year highs and lows. That can really skew your results if you have some sort of outsized move sometime in the last year that doesn't really track well. And this is actually a good example right now. Meta has an implied volatility percentile of 50% right now, but it's telling you the IV rank is 23.52%. That would lead you to believe that the current vol of 37 is low, but implied volatility percentile is telling you this is not low. It's telling you 50% of the time it's lower than it is right now. So this is quite high. So this is why I prefer implied volatility percentile. It's way less skew prone. Now, one admin note for those that use Thinkorswim, this still reports IV rank. This is not implied volatility percentile. This is IV rank right here. And again, you can see based on the calculation. For those that are in the pro community, you guys have access to this Think script. For those that are in Thinkorswim, and as always, you can just use ChatGPT to make your own as well. Okay, so we have IVP, IVR. Let's talk a little bit about the surface now. We already talked about the different types of vol. When we talk about the implied volatility surface, this is it. It's literally just taking the volatility for the individual options, the strikes. It's taking the volatility across different time frames and it's comparing them all. Now, sometimes an implied volatility surface can be 3D. I'll grab a photo of that for you now. Something like this. And it's effectively the same thing that I'm showing you here. It's just 3D instead of 2D. So what we can do is we can analyze things like term skew or vertical skew. And I'll show you exactly what this means. If we go into Meta and I take a look at implied volatility, I'm going to get rid of some of the series just so it's not quite as noisy. We'll do like 3 of them. So term skew is really simple. It's just which term has volatility compared to the other. So in this case, we can see that the 18 July term is 29%. And if we compare that to the 15 AUG, we can see that it's a little bit low. So we can see that more simply here. So term is simply comparing volatility of expirations across one another, and we can do it at individual strikes. Now, when we talk about stuff like Smile, that has to do with the relationship. It's displaying a relationship. So in this case, you can see that the implied volatility for Meta kind of has more like a smirk. It's not really a smile. When we're talking about something like a smile, let's see if this is, yeah, this looks a little bit more like a smile to me. So you'll see that there's some expirations that are very flat. And then there are other expirations that have really high volatility out at the tails. So when we say a smile, essentially we're referring to volatility across the individual term. And we're saying, how do the out of the money and at the money option vols compare to one another? So most of the time for vol, we're going to use out of the money option. So it'll be the out of the money puts and then out of the money calls. So out of the money puts are the lower strikes. Out of the money calls are the higher strikes. So we can see if it slopes up, if it's flat, if it, let's say using this down here, if we see this kind of configuration, if you know what this is, throw it in the comments. If you don't, that's fine. What this means is the out of the money puts have more vol than the out of the money calls. We can see that because, again, we know that the at the money is right around where the lowest point typically is. And you can also just check the price. And we can see that the puts have way more vol in them than the calls. This is common. This is called put skew. So we can analyze skew across expirations, across individual strikes, across type of option, calls versus puts. And it's really informative in that this kind of configuration tells us that the market is pricing in a potential for a larger magnitude downside move, but typically slightly lower probability. And then if we see this really low vol, that's a lower expected magnitude, but a slightly higher probability. That is surface in a nutshell, along with taking a look at different terms and their corresponding skews. Now I want to talk about Vega and Vomma. So we can visualize Vega, and Vega is pretty simple. Vega is going to be higher for further dated options. There's more extrinsic value in those. And it's going to be highest for at the money options because there's more extrinsic value in those. So you'll notice that as we go deeper in the money or deeper out of the money, no matter where you are, your Vega is going to contract. And Vega simply tells us what is the expected rate of change of an options premium per 1% change in implied volatility. And I have a video that goes through all the Greeks in detail. You can check that out at your leisure. So when we're talking about Vega, it's really important to understand this specific relationship, because I had a comment in a live stream a while ago and they were saying GameStop implied volatility is really low. Should I buy leaps? And it's a great question. But this goes back to an important point we were talking about before, which is the terms do not behave the same. So what this means is if we get a change in, we have Palantir up now. If we get a change in Palantir price, and let's say the implied volatility goes up a lot, let's say it goes from 71 to 91, that does not mean that that's going to impact all the terms the same. Actually, quite the opposite. Even though terms that are further out in time have higher sensitivity to Vega, they tend to experience lower shifts in implied volatility because they're so far out in time. And here's a way to visualize this simply. This is also in Palantir. I want you to take a look. Let's grab Meta, because I think it doesn't have this crazy skew thing in here. Or we could just get rid of that. Yeah, Meta's great. So first, let's get rid of the 7-day options. And let's just take a look at 30 and 60. Notice the difference between these. 30-day vol, for example, has been expanding from the 27th of June. It's literally increasing, whereas 60-day vol is literally decreasing. This is showing you that you have to align your expectation of volatility with the term, or at least take it to an account. Because in the context of somebody that thought implied volatility percentile, that was the question, was really low in GameStop. Well, if you're buying really long dated options, leaps, because implied volatility percentile is low, you might not get the result you want, because implied volatility percentile is relative, again, unless you manually change it, to 30-day vol. So this is an important takeaway when you're looking at things like Vega and then also impact of vol across the term. Now, Vomma is a higher order Greek that tells us how much Vega changes. Think of it as the gamma of Vega. The reason why this is important is because if you're selling a lot of really far out of the money options, you can think you're pretty safe. But then all of a sudden, if implied volatility changes and something has a lot of Vomma, because the Vega can expand very quickly, your position can move pretty meaningfully against you. And I want to give you an example of something like this. This is, again, just a simple example that I built. And this is looking at a stock, I think it's Palantir, in 25 April versus 5 May. And this is looking across different expirations. In 25 April, you can see the implied volatility. I normalized for 49 delta. You can see the implied volatility for these different expirations. Cool. You can see the Vega for these different expirations. Cool. Now, if we go to 5 May, I want you to take a look at the change in implied volatility. The 7-day vol ballooned. It went from 66.5% to 136%. A massive change, a 144% change in overall, 82. There was a 144% change in premium, but an 82-point change. This is not a percentage, right? So 82 percentage points between these two. So it's over 100% change as a percentage. Big, big move. And take a look at what the premium was before. It was $3.15. After this big change, the 7-day options when implied volatility went to 136, the premium went all the way up to 7.7. This is where people can get caught because implied volatility can massively accelerate things. The other thing you should note is that as implied volatility for the 7 days went from 66.5 to 136, take a look at what happened to 30-day. 30-day literally went down, went from 87.5 to 84.5. 90-day went up a percent in change, 1.4%. Percentage points. So the point I'm making is that you have to pay really close attention to the different terms with respect to volatility because they're not all the same and they behave differently. If you're trying to base a trade off of one of these and you're not taking this relationship into account, you typically get a result that you are not expecting. All right, let's talk about mistakes, rapid fire. First one, premium chasing. This is where people that are selling options will try to find the options that give them the most premium. That's fine. But if you're doing that, you're typically in really high volatility names. That can be part of your plan, but you have to remember, high implied volatility means high expectation of price movement. So people that do this are typically fighting a lot, and it's because the stuff is moving. This idea of buying when IV is low or selling when IV is high. It's not inherently wrong, but it's nuanced. So we already talked about one element of that through the concept of terms. The next concept of that is if you're actually trying to isolate volatility, you're not so concerned if IV is high or IV is low, but you're actually concerned about the relationship between implied and realized volatility. So here's what this means. You can have periods where IV is really high, like this. This is a high IV stock, Palantir. Implied volatility is really high here as a percentage, but notice how you're still losing. And it's because the realized move is even higher still. So when you're trading implied volatility and you're trying to isolate it, you really care way more about this relationship between implied and realized volatility than raw or even IV percentile. Again, a great example is you can have something that has a really high implied volatility percentile, really high IV, but then the realized moves are bigger. So if you're trying to isolate the directional move and the mean reversion of volatility, you can do that, but you still have to be careful when you choose to do it because we know that volatility clusters. Next, high implied volatility equals high IV risk. It's not so much the case. It just means higher movement. One of the benefits here is that if you're selling options, you tend to collect more. Now, high IV can be high risk for sure, but it's not because it's high IV inherently. It's just because it's what it means that the stock moves a lot, but it's not inherently super risky. We already talked about the importance of paying attention not only to volatility, but also volatility in the corresponding terms when you're entering your trade. Again, great example was that leaps scenario I gave in GameStop. They weren't ignoring vol because they were thinking about implied volatility percentile, but they were not aligning off of the durations. We talked about calibrating against the assets. So a common mistake is to compare the implied volatility of things against things that shouldn't be compared. Again, this is comparing Palantir against a utility stock. Comparing the raw IV against those doesn't make sense. IV P&L expectations is tricky because it's really based on aligning off of all of this. Sometimes people think Vega has more of an impact or less of an impact. The way that you can calibrate this is by seeing what the Vega is so that you can actually determine what you might expect to see versus just guessing. Skew is really important because it gives us a lot of really useful information like we were talking about in terms of market expectations, or maybe informing if I want to get short something, if I want to buy or sell options, I can use that to figure out how I want to play it. IV collapse and expansion is really widely misunderstood because sometimes we overemphasize how much it can be or underemphasize. The thing to pay attention here is that it can have a lot of velocity depending on what the event is, like earnings, but you can measure this. You can see how much implied volatility tends to move around other earnings events for the thing that you're looking at. So you can calibrate even this. Another common mistake is the assumption that implied volatility is linear or that it doesn't change. But again, after this video, you know objectively that's not the case. Implied volatility is very dynamic. So taking that into account really helps select better positions. The last one, volatility regime. We talked about how volatility tends to cluster, and the broader regime is actually highly informative. So if we're in a period of high clustering, that tells us that stuff is really moving a lot. That can, again, inform the trade decisions that we look to make. So this is a pretty holistic overview of implied volatility in options trading. You now know, hopefully, a lot. And if you learned something, post what you learned in the comments below, because I genuinely am interested, and I also want to see if I delivered on my promise, which is that you should learn something. If you have any questions, let me know. Be an outlier. See you guys later.